and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to try and take stock of what's happening on the global economy, global, domestic, and the kind of havoc we're seeing in markets across the world. And we have an excellent panel to do that. So I'll cut short my opening remarks and go straight to our panelists. H.R. Khan, former Deputy Governor, Reserve Bank of India, T.T. Ram Mohan, Professor, Indian Institute of Management, Ahmedabad, and Anant Nageshwaran, part-time member of the PMEAC. Well, this is as close as you can get to a perfect storm. With mayhem in the oil, stock markets, currency markets, fear of a pandemic that the WHO has suddenly said is really a pandemic, slowing growth in Japan, already in recession, Germany close to one. So are we on the brink of another global recession? Let me start with you, Anant.
Thank you, Mythili. I just have to first clarify that I'm speaking in my personal capacity and not as a member of the EAC. The situation is evolving so quickly that what I say today may end up looking silly tomorrow, assuming it is not silly today itself. But be that as it may, I think we are on the brink of a global recession. So the answer is yes. In fact, the global expansion, particularly in the US, is almost 11 years old, and it was showing signs of weakening. And this just simply is the straw that actually breaks the camel's back. So I think we will definitely see a global recession. Of course, there could be statistical window dressing by many government agencies across the world, but barring that, I think we will see statistical data that will show that in 2020, the global economy did enter into a recession.
TTR, do you agree with that rather dismal assessment?
Well, I think global economic growth is going to slump, and some of the international agencies have said something like 8 to 10% below what was forecast earlier. But I think I'm not very sure that it's going to be a full-blown recession, say, compared to what happened in 2008. And even if there is a slump in growth, I think the prospects of an earlier recovery are much better this time than in the last crisis, when the conditions were very different. We can talk about the differences in the two conditions as we go ahead.
Okay. Khan, where do you stand? Anant was quite despondent. TTR a little bit more optimistic. Where are you? Somewhere in between, Khan?
I think I'll tend to agree with Professor Ramon. I think the situation is bad, but not really that bad that we can't recover. And certainly there is going to be maybe 80 to 100 basis point fall in what has been projected. In fact, IMF has projected some sharp reduction. But I'm hopeful that maybe after a couple of months we should see recovery. But these next couple of months are going to be very, very critical and important. And we need action both domestically and globally. I think it depends on how we pan out over the next 2 months and how the corona plays out and how is our response to that. And that is very critical. But I am hopeful that we should recover.
Anand Khan spoke about coordinated global action, but can we really expect or even hope for coordinated global action from global leaders, central bankers, on the lines of what we saw in the days after the collapse of Lehman Brothers, or when you have somebody like Donald Trump in the White House? Is that too much to expect? Any kind of coordinated action at all, Anand?
Well, first of all, Mythili, your first question was about a recession. It wasn't a question about a recovery and how soon it would come. So even though I might have said there is a recession that is baked in the cake, I didn't discuss the recovery. But be that as it may, I would still maintain that even the recovery, on the optimism on the recovery might be premature, because in the last 2 years, like we had in the 2008 situation, this time corporate subprime borrowing has picked up quite a bit in the last 2 years. If you look at the issuance of bonds, sub-investment grade or the lower rated investment grade bond issuance had been much higher than the higher rated investment grade bond issuance in the US. And if you talk about coordinated action, what can they deliver? I mean, first of all, if you see that there is a coordinated beggar thy neighbor policies when it comes to banning people from moving across countries now. So it is not a coordinated sanguine response, it's a coordinated, desperate response. And even if you coordinate monetary policy response, how many bullets you have left to fire? You have used up all the bullets for frivolous reasons in the last 11 years. So that is why I think both the prospect of a recession and the prospect of an imminent is high, and the prospect of an imminent recovery should be at best considered neutral, at worst low possibility.
Well, yes, it is true that it seems to be a rather bleak scenario, but TTR, there is a silver lining for us, isn't there? Because low oil prices is good news for us in India. It's estimated that we will save at least $20 billion in foreign exchange, and that saving and related government improvement in government finances should serve to offset at least some of the global and domestic slowdown. Can we take advantage of this? How best can we do it? Can we really hope to make up for some of the shortfall that we're seeing in tax revenues? As during the last time when oil prices fell, and government was able to keep tax revenues by raising excise duties, etc. So there was, some kind of a silver lining. Can we hope that oil will be our silver lining, or do low oil prices really spell poor economic growth for the world, including India at large?
Well, you're right on both counts. I mean, the fall in oil prices is certainly a positive for the current account situation. It's a positive for the fisc. At the same time, it's a negative for export growth because, global economic growth is bound to decelerate. But overall, I think for a major oil importing country such as ours, the impact overall should be slightly positive. But I think for us, the worry is not so much the adverse global conditions as the conditions at home, and especially the severe stress in the financial sector. So I think this is happening. The exacerbation of global economic conditions is happening at a time when the financial sector is severely stressed, and we've had a very significantly negative episode in the shape of Yes Bank. So it is the happenings at home which should be a matter of concern. But let me address the question which you raised about global response to this crisis, and the knee-jerk response to have monetary and fiscal stimulus. And I'm not sure that that is at all the appropriate response in the present situation, because the problem is not so much a collapse in demand which is happening as a result of the collapse of banks, which is what happened in 2008 crisis. Here you have a problem that people can't go out to work, they can't travel, supply chains are getting disrupted. So overall, the supply side, there is a major disruption, and so the revenues of firms are falling, and they respond to that by laying off people, so demand falls. So that is a sequence in which events are unfolding, and in this situation I'm not sure that you can do a great deal through monetary or fiscal stimulus. How does it help to reduce lower interest rates? Because it's not demand which is really a constraint. That is not the fundamental problem. But there are other responses which governments can come up with, and I'm happy to discuss this as we go along.
Oh yes, we need to look at some responses, since the conventional responses don't seem to work. But Khan, at the end of the day, what we're seeing is a huge sell-off by foreign portfolio investors as they rush to safe havens. The RBI has clearly been intervening since the rupee recovered after having crossed the $74 to the mark. Rupees to the dollar mark. It was the lowest since 2018. Given our comfortable forex position, should the RBI in fact intervene more aggressively, or should it allow the rupee to depreciate? Because given that exports are anyway falling, you need any kind of support, and a depreciating rupee is good for our exports. Khan?
I'll just want to point to what you discussed about coordinated action. What I meant by coordinated global action, not so much in the fiscal and monetary space, but in the field of health and hygiene. So WHO has come out, as you said, about pandemic. So how the nations coordinate in terms of seeing that their population are protected, quarantined, and across the country how the research is quickly done and how the benefits of research is shared, and the whole issue of health and hygiene cutting across borders. I think that is the most important thing that has to be done. So similarly in the country, let me also add, I am not talking like a political scientist here, but I would say that given the grim situation, I think we should declare quote unquote a national emergency, and the parliament and the rest of the nation should be focusing on this pandemic rather than other issues which should be put on the back burner, and there has to be huge political consensus across the spectrum to fight it as a national calamity or national priority. So that is both the national coordination and global coordination part is concerned. The second part is in terms of Indian market, as you said, crude is a silver lining for us, but then provided we do it properly, because crude also will have the issue of remittances slowing down, but net we should be gainer provided we take this opportunity, make best use of this opportunity. As I say, no, you should not waste any crisis. So far the markets are concerned, you mentioned about forex volatility and rupee falling and all that. You know, for a long time we are one of the outperformers, and for last few weeks we have been underperforming. I think in balance, I think we should not allow too much appreciation, because that should provide an easy exit for the people who want to exit early. So we should be little circumspect in trying to intervene aggressively. It is all falling all across, and you have a huge war chest available, but you should not waste it when things are falling like tailpins. So you should be doing bit of a sprinkling and bit of a active intervention when there is a need. So it needs a tactical response rather than going overboard and trying to see that rupee doesn't go down sharply. I think we need to a nuanced and balanced approach, even though we have a war chest, but we need to have a nuanced approach. That's my sense.
Yes, these are difficult times for sure, but Anand, you know, we all agree that oil is a silver lining for us, but do you see these low oil prices sustained over the longer term? Is it, as some claim, a proxy war really between Russia and the US? Because US shale oil producers are likely to become unprofitable if oil stays below $50 to the barrel over the longer term, in which case, where do you see it all end, Anand?
So obviously, this is going to be a very difficult call to make, whether the crude oil price continues to drop further or it stabilizes. And I think right now what we have had in the last 1 week is a combination of both supply and demand shock, because the coronavirus impact is already, the market was pricing in oil demand slowdown, and then simultaneously we had the OPEC plus meeting ending with no agreement. So I'm not very sure that this combined effect which brought down the price will remain for a long period, because the producers would eventually see the folly of their action and would come to some sort of an understanding. So there is a silver lining, and I personally believe we need to take advantage of that, at least partially, by hedging some of our future oil purchases, if not the full quantity. After all, we buy sour and sweet crude in the ratio of roughly 3:1, and it is the sweet crude that has a lot of liquidity in the global marketplace in order to be able to hedge. So I think we should not be waiting for further oil price correction. If it comes, it's a bonus. I would personally think we should lock it in for the next 2 to 3 years, so that we can at least calculate the extent of windfall we have gained compared to the prices that prevailed about 3 to 6 months ago. So I wouldn't continue to bet on further slide in the oil price. That will be an act of speculation, whereas locking in the current low price would be an act of prudence on the part of policymakers.
TTR, the crisis has hit us at a particularly unfortunate moment of time, at the time when the global economy is slowing, our economy is slowing, compounded by, as you said, the weakness in the banking sector. What really explains the continual spate of bad news in the banking front, cutting across, frankly, both public and private sector banks, of which Yes Bank is only the latest example? Can we expect more bad news as the economy slows further, and what can we really do, TTR?
Well, I think the financial sector has been under stress for quite some time, and to my mind, you know, the crucial point was the collapse of ILFS in September 2018. That should have been prevented. There should have been a rescue of ILFS at that time, and I think what has been unfolding since is the result of the flight of confidence from the banking system, from the entire financial system, the NBFCs and to some extent banks, and culminating eventually in the collapse of Yes Bank. Now, one of the things that should have happened, you know, as I said, is, you know, ILF should have been rescued in the first instance, but since that is in the past, I think the rescue of Yes Bank, the entire plan, should have been put in place at the time that the supersession of the board was announced. But I think we've had too many days elapsing, and the cap on deposit withdrawals beyond rupees 50,000 of 1 month has proved quite disastrous for confidence in the banking system. So I think the crucial step to be taken is to now expedite the rescue. I'm not at all happy about the plan which has been proposed. My own preference would have been for straight nationalization of Yes Bank or a merger with SBI, but what they are trying to do is to put together a consortium of banks and private investors. It's taking too long, And in a crisis situation such as this, time is of the essence. And it does appear that things have been allowed to go on for far too long, and the damage may prove quite irreversible for the time being.
Yes, TTR, I agree with you that nationalization merger would have been better, but you and I are a really complete minority on that. But I'm afraid it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts on trying to understand, dissect what's happening in the global economy, in the Indian economy, and the banking sector in particular in the Indian context. Khan, before the break, TTR was talking about how Yes Bank is not very happy with the time that was taken to come out with the rescue package, the quality of the rescue package, etc. So here I'm asking you to put your neck on the line maybe, but can some of the responsibility for the mess in the banking sector be laid at the door of your former employer, the Reserve Bank of India? Could better supervision have nipped these problems in the bud? In the case of PMC, you could argue that dual control was the reason why RBI could not really do very much. But in the specific case of Yes Bank, the deterioration in the health was well known for almost 2 years. But was RBI a little slow to act, Khan?
One has to look at in a perspective. RBI did take action in terms of not allowing the former CEO to continue. They put in place somebody from RBI on the board, and they were looking at whether new management can get investors. So they were telling investor is coming, notifying, then saying not coming. So it was going on. So in such cases, the approach has been to allow the market mechanism to work its way through. But as it didn't work out and the deposit withdrawals were happening rather rapidly, so RBI did intervene. So the question whether they could have intervened little earlier or not, I think that judgment has to be based on many factors. So because the bank management was giving an impression, there are also reports and filing on the exchanges that new investors are coming. But the problem with new investors was possibly they were not knowing how big is the hole in the Yes Bank system. So, and along with that, there have been some issues in terms of credit quality, but along with that, the slowdown has further compounded the problem of many banks, including Yes Bank. So it has multiple factors. So whether RBI could have acted faster or not is something we can't judge it on the spur of the moment.
Yes, indeed. There are tough times for any government. But Anand, let me take you away from the banking scene in India and turn to the latest fear factor, coronavirus. Looking at the way it's spreading, how do you see it play out? The US-China trade war actually gave us an opportunity to get into the global supply chains, but we lost out there. Will India be able to benefit, however horrible it sounds, from global players realizing the hazards of depending on China as a sole source for many essential items, especially essential ingredients? Anand.
I think the benefit for India, either from the US-China trade dispute or the coronavirus-related supply chain disruption, should first be felt in the bilateral trade deficit with China, because we have a close to about $50 billion or thereabouts bilateral trade deficit with China, and to the extent that some of the imported components from China are not coming through, and where there is domestic substitution available, that would happen. So we will first see some impact, positive impact in terms of the shrinking of the Indian bilateral trade deficit with China. The second question is the supply chain disruption in China, which whether India could take advantage of it or not. I think this is unfortunately a long-term work in progress, and the bulk of the action perhaps lies with the state governments in terms of the ease of setting up businesses or being able to run them profitably. You have to worry about land allocation, water, power connections, etc. And most of them lie in the realm of the state government. So this is a situation where state governments have to take action, and I think unfortunately this will take a longer time. So I'm not too sure whether we could take advantage of the supply chain disruptions in the short run at all. I would be somewhat pessimistic about the prospects for the near term.
Oh, well, yes, there's pessimism all around. But TTR, as someone who keeps a keen eye on the banking sector, how do you really see the Yes Bank rescue package? Yes, you said you were not very happy with it, because as with Global Trust Bank, once again, State Bank of India, public sector bank, has been asked to come to the rescue. The RBI's draft restructuring scheme envisages SBI picking up a 49% stake in Yes Bank. But the expectation really is that even with this 49% stake, SBI's contribution will not suffice to fill up the hole in Yes Bank's balance sheet. If that is correct, will we see depositors flee once the moratorium is lifted? How better could we have handled it, and why is nationalisation such anathema? Because the UK government, in the context of Royal Bank of Scotland, post the global financial crisis, did nationalise and subsequently got out of it. So could we have done something like that? Would that have been a better use of taxpayer money? Because SBI is also ultimately taxpayer money, and minority shareholders also get taken for a ride in the process. TTR.
Well, here I think, as Mr. Khan mentioned, the intention in not nationalising was partly to limit the impact on the fisc. So they are trying to get some private investors to pick up the tabs, including domestic private banks, and it remains to be seen how much of appetite they have for infusing capital into another private bank. And I think the pricing of the share is also going to be a sticking point. I think there is concern already among SBI's investors about SBI having to pay a premium to the face value. I think it would have been much simpler if you had just written off the net worth of the company and offered the share price at ₹1. In that case, you would have even been able to attract some private investors much earlier, is my feeling. So the moment RBI realized that price was a sticking point, I think they should have intervened. But now that that is passed and SBI is getting into the picture, I think at least on pricing, if they want to interest private investors, I think at least that should not have been allowed to be the sticking point. But whatever rescue package they put in, my own sense is that too much time has passed. And the question that depositors, especially bulk depositors, will ask themselves is, why should they stay on with the bank after all this has happened?
Okay, we'll have to wait and see. But Khan, do you think that this shows the fallacy of depending on wholesale banking, as it were? One of the strengths of the Indian banking system has been the dependence on retail deposits, unlike banks abroad, whereas you did see the new private sector banks being excessively dependent on wholesale banking, and that is really now seems to be their Achilles heel. Also, since you've been like the father of corporate bonds in India as such, and therefore of bonds in general, what about the treatment of 8 additional tier 1 bonds? The RBI's restructuring scheme envisages that their rights will be subservient to those of equity shareholders. Will this really mean finito to the AT1 bond market as such, Khan?
2 points. First, on what is going to happen once the moratorium is lifted. As Professor Ramon said, it is going to be a very, very challenging time, whether the depositors will stay put or there will exodus will continue. I think the key lies here to put in place the capital, put in place a strong management, put in place a board which will inspire confidence, and very, very important is communication. How do the new management communicates as well as government and regulators communicate? So that is going to sway the tempers or the mood of the depositors. So that is very critical post lifting a moratorium. And the second point on AT1 bond, I think reams and reams of material has been written on both sides. Whether it was a fair, whether it is technically correct, tactically correct, what is going to happen in the near future about the AT1 bond. Many banks still depend on that, including public sector banks. What has been the role of rating agency? Whole host of you, whether it is fully Basel compliant, whether it letter and spirit it is okay, or they should have given equal treatment like equity holder. I think the whole host of issues have come. I think some people have gone to the court, and the sense I get, probably RBI and those bondholders have some discussions going on. I think some solution would be found. They have to take a haircut, whether it is haircut is 100% or 70% or 80%. I believe some compromise will be worked out. You have to remember, AT1 has a loss absorption feature, so that has to be kept in view. And because if you don't write down AT1, what the point you mentioned, taxpayers money amount to be put in this bank will increase enormously. So that is another factor to be kept in view, because if you don't write down AT1 bond, your capital requirement will go up hugely. But having said that, some semblance of rescue to them in terms of huge haircut, but some amount, some skin in the game, probably RBI is working out. I think let us wait and watch what would be that sort of a solution or compromise?
Okay, Anand, I'll give you the last word because time for us to wrap up this show. We really run out of time. But if you look at all the previous crises, and we've had many, at least in the Indian context, we have had 1991, then we had the East Asian crisis, the global financial crisis, the taper tantrums. Viewed against all this, are we in a much worse situation today when you compare them? Or are we really better off? Because remember, the difference between this and the earlier crises is that this is originated in the real sector. And does that make a difference, Anand?
No, I think this crisis began in the financial sector with the NPAs. So clearly, it is similar to the many financial crises we have had. And in a kind of a good news for India is that the bulk of the Indian financial story has already unfolded. And in the global context right now, what we have is a silver lining in the form of a lower crude oil price. So net, I would think India would come out relatively less affected by the end of 2020 than what it was by the time year began. So I think from the Indian context, I'm not that concerned as I am about the global context.
Okay, so it's good to see that you don't seem unduly concerned about coronavirus, because right now at the moment we seem to be panic all around the world with worries about what does it imply for the global growth, for the world, safety, lives, etc., etc. But thank you so much, Anand, Mr. Khan, as well as TTR for joining me in this really fascinating discussion, which could go on forever and ever because we really do not know which way is going to pan out. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.